The market. It is not a philanthropic institution. It is a machine, a great grinding apparatus designed to transfer wealth from the impatient to the patient. The common man, the fellow trading on tips, on whispers, on the excitement of the moment, he believes the market is there to reward his prediction. He thinks his analysis, his clever calculation, means something. It means nothing. The market is there to destroy your impatience. That is the single greatest lesson I have ever learned. You see these plungers, these speculators, these everyday men who are ruined and pushed out of the game? They were not wrong about the direction. Not fundamentally. They were right too early. They mistook the opening salvo. They bought the rumor. They sold the first flush of panic. They acted before the time was ripe. They confused the noise of the market operators setting their trap for the decisive battle that would confirm the trend. You must stop getting played. Stop reacting to every phantom move designed, calculated, and executed merely to lure in the unprepared, the greedy, the man who cannot wait 5 minutes longer than necessary. You must learn to wait. You must learn to demand that the market confirm its own intentions. You do not ask it. You do not beg it. You wait for the confirmation. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. Let us speak plainly about the tax you pay for being a fool. The false breakout. The movement that promises salvation, that flashes green and pulls you in only to reverse violently, swallowing your margin and leaving you stranded. That is the market's primary, most reliable tool for separating capital from the impulsive trader. It is a tax. A whipsaw tax. And the cost of this tax, gentlemen, is far greater than the dollars you lose. The financial loss is a mere fraction of the true injury. That is simple arithmetic. The deeper, more insidious damage is the emotional debt you incur. When you chase a premature move and it reverses, you are not just poorer. You are psychologically maimed. You become hesitant. You become bitter. You start second-guessing the very systems that could have saved you. The market has now done two things. It has taken your money, and it has impaired your ability to execute the next genuinely profitable trade. You develop flinches. You see the true, verified move come, the one you waited months for, and you hesitate. Why? Because you remember the last time you were seduced. You carry the memory of that false break like an open wound. This emotional debt is the reason men fail repeatedly. They trade the memory of the mistake, not the reality of the tape. They are paralyzed by fear of the whipsaw they just suffered, and they miss the real plunge because they cannot commit capital again. Do not pay this psychological price. It is too costly. The price of patience, conversely, is merely a few points of profit lost at the entry, a premium you pay for certainty. But you must understand the psychology of the lure. False breakouts are not accidents. They are engineered moments. They are carefully constructed illusions designed to appeal to the universal human urge to get in first. We all want the lowest price. We all want to catch the absolute bottom, or ride the very first swell of the tide. This greed, this urgency, is exactly what the operators are selling back to you. Watch the tape when a false break occurs. You will see it move sharply, often with an exaggerated momentum that looks terrifyingly real. It breaches a known resistance level. The amateur sees this on his chart and shouts, "There it goes!" He scrambles to buy. He is afraid of missing the run. But look closer. Study the internals. These instant breaks often occur on reduced volume. Or if the volume is spiking, it is followed immediately by a sharp reversal that eats the gains in minutes. What does that tell you? It tells you the move was fueled by retail emotion, by fear of missing out, by thousands of small speculators piling in simultaneously. It was noise. It was not fueled by institutional conviction. It was not supported by major capital entering the fray and settling in for the long campaign. The big money, the pool operators, they are not chasing these sudden rockets. They are selling into them. Your task is to recognize this trap before the trap recognizes you. You must stand aside and watch the frenzy consume the unprepared, comfortable in the knowledge that this explosion is merely a flash in the pan. If a move looks too easy, if it feels exhilaratingly fast and clean, treat it with extreme suspicion. The decisive moves of the market are rarely granted easily. They are usually preceded by boring, grinding accumulation or distribution. The sudden sprint is usually the feint. Zaccharees. The third principle is the bedrock of all safe trading. The principle of the time test. I speak of confirmation, and confirmation is not merely a price level being breached. 1,000 points are breached every day. Confirmation is a price level being held over a sufficient period. When a stock breaks through a major pivot point, a resistance line, a barrier built over weeks or months, it is making a statement. But the market demands that the stock demonstrate resilience. It must prove that this new price range is acceptable. Acceptable not just to the momentary flash of excitement, but acceptable to the dominant forces that control the movement of that stock. Think of it as a territory being conquered. You may storm the wall, but if you cannot hold the ground you've taken, the battle is lost. If the price breaches the resistance and immediately retreats, diving back below that crucial line within the hour, the confirmation has failed. The test has been lost. The ground has not been held. You must allow the market time to digest the new price. Let it settle. Let the sellers who are waiting just above the resistance be absorbed. Let the momentum buyers be given their chance to prove they can sustain the altitude. If the stock can consolidate just above the breakout level, if it can trade horizontally for a day or two, perhaps 3, without returning to the old territory, that is confirmation. That tells you the market believes the move is legitimate. The new price is accepted. Until that time test is passed, you are simply risking your capital on an unverified rumor printed on the ticker tape. Chars. The movement of price is only half the story. The movement of capital is the other half, and that is measured by volume. Volume is the confirmation witness. A true, meaningful move in a major stock requires substantial capital commitment. It takes serious money to shift the inertia of a market that has been held stagnant by supply and demand equilibrium. If a major resistance level is broken on thin, anemic volume, treat it as a theatrical stunt. Treat it as noise. Treat it with extreme suspicion. It is likely the work of a few small operators trying to incite a retail chase. Real breakouts, the ones that lead to sustained campaigns, the kind that make fortunes, are validated by a significant, undeniable surge in trading volume. The tape must scream conviction. The volume must tell you that big money is entering the position, that large pools of capital are being repositioned, that the professional traders are committing funds, not just testing the waters with a few thousand shares. I want to see the volume double. I want to see the transactions accelerate to a fever pitch as the price moves decisively. If the price moves up but the volume is drying up, that stock is moving on fumes. It is moving on the enthusiasm of the weak hands who do not require much money to make a purchase. Volume must confirm price. Always. If the confirmation witness is silent, the testimony is worthless. The move is hollow noise, destined to collapse the moment those thin buyers decide to take their small profits. You are not trading the chart lines. You are trading the commitment of capital. And volume is the only reliable measure of that commitment. Observe the way a confirmed market moves. It is straightforward. It is determined. It is the straight path rule. When a stock genuinely breaks a key pivot point, it typically continues its momentum without significant hesitation. It takes the line of least resistance. It is like a river breaking a dam. The water flows powerfully through the gap, accelerating as it goes. If the price stalls directly above the breakout level for too long, if it begins to chop and grind, unable to move convincingly forward, the market is signaling confusion. It is signaling a lack of genuine conviction among the large players. And they should have been ready to buy immediately upon the break, sweeping the stock higher. If they are not, something is wrong. Worse still, if the price immediately dives back down to test the old resistance, almost as if it regrets breaking out in the first place, that is the market telling you the previous supply zone has not been cleared. The resistance remains functional. That is your signal to stay out. A powerful move does not immediately need to look backward. It establishes the new path and drives forward. If the stock cannot immediately establish a clear new channel, if it lingers too long at the edge of the old boundary, you must wait. You are looking for clarity. You are looking for the path of least resistance to be established by those who control the market's immediate direction. Do not try to force a clear path where confusion reigns. Wait for the market itself to decide which direction is the easiest for it to travel. Here is where the average speculator loses his patience and his shirt. He wants to catch the initial impulse. He sees the spike. He sees the rapid ascent away from the breakout point, and he is overcome by the fear that he is going to miss the biggest run. This explosive part of a sudden breakout is often the most dangerous territory to trade. It is the region of the weakest hands. Why? Because the initial momentum blast attracts the largest number of impulsive small buyers who are chasing the action. Their entry fuels the spike, but their dedication is shallow. They will sell at the first sign of trouble. If you chase that initial rocket, you are entering exactly where supply is likely to reassert itself. You have no buffer. Your stop must be too far away, or you will be shaken out immediately. The professional trader allows that initial momentum blast to run its course. He lets the froth be blown off the top. He waits for the first controlled consolidation. He waits for the minor pullback that inevitably follows the initial rush. This consolidation, this brief period of rest, is the market verifying that the breakout players are stable, that they are holding their ground. This moment, this pullback to the former resistance line or the first minor consolidation zone, provides a far safer, higher probability entry point. Yes, the absolute price will be slightly higher than the initial break. You might give up a point or two. But you have gained something infinitely more valuable than those lost points. You have gained certainty. You have gained a tight, clear point for your stop-loss order. You have entered after the stock has proven it can survive its own excitement. Never chase momentum. Wait for the stock to settle down and show you it means business, not just momentary excitement. When a stock breaks resistance, many inexperienced traders place their stop-loss orders just above that resistance. If it breaks support, they place stops just below the support. This is textbook knowledge, and it is suicidal. The market operators know this. Many initial spikes and plunges are designed purely to shake the tree. They are stop-loss hunts. The big operators are not moving the price primarily to start a trend. They are moving the price to trigger the massive cluster of stop-loss orders that exist at the obvious pivot points. When stops are triggered, they become market orders, meaning selling pressure fuels the up move, or buying pressure fuels the down move, depending on whether you are crossing a short stop or a long stop. This allows the major operators to fill their positions at better prices, creating liquidity where none existed moments before. If you are entering on the initial spike, you are often entering directly into the mechanism of the stop hunt. The market pushes just far enough to trip the stops, absorbs the liquidity created by those forced transactions, and then reverses back to its true intention, leaving the early entrant utterly confused and trapped. You must wait until the hunting party has left. You must wait until the market has successfully absorbed these stop-loss orders and, critically, failed to reverse sharply. Only after the stock has demonstrated that it is willing to move beyond the stop-loss cluster and maintain that higher price does it reveal its true, underlying intent. Patience is the camouflage that keeps you hidden while the stops are being hunted. Wait for the genuine movement to begin, executed by those who are serious about direction, not just harvesting liquidity. Speculator. The absolute gold standard for confirmation, the principle that removes nearly all doubt, is the pivot point conversion. This is the rule of demonstrated reversal of function. For a true sustainable breakout to be confirmed, the previous resistance level must successfully convert into a new functional support level. Think of it physically. A ceiling, resistance, is broken. It is now a floor, support. The crucial step is that you must wait for the test. After the stock has broken resistance at, say, $50, it races up to $52. But then, the initial momentum wanes, and the stock retreats. It pulls back. Where must it stop? It must stop at $50. You wait for the market to retest the broken level. The price must touch or come very close to that former barrier. And then, it must successfully bounce. If the market retests $50 and holds, if it finds buying support exactly where it previously found selling resistance, then the pivot point has demonstrated its strength. It has officially converted. It has confirmed the continuation of the new trend. If the stock plunges straight through $50 back into the old territory, the breakout was a failure. The test was lost. This principle separates the men from the boys. It requires the greatest patience because you are often waiting days or even weeks for the market to complete this structural conversion. But when it happens, when resistance becomes support, or support becomes resistance, the resulting move is usually substantial and sustained. You are trading off of structural integrity, not momentum alone. This is where you commit your capital with confidence. This is where you know the dominant forces have signed off on the new territory. I have heard the lament 1,000 times. But Larry, if I wait for all this confirmation, I will have to pay a higher price. I will miss the first 5% of the move. My answer is always the same. Do not fear paying a slightly higher price for certainty. The cost of being early is always mathematically exponentially higher than the cost of being late. Consider the arithmetic. If you enter a trade early trying to save a point and the market delivers a false breakout, you are stopped out for a loss of 5% to 10% of your capital on that transaction. You have suffered the whipsaw tax and incurred emotional debt. Now compare that to waiting. If you wait for confirmation, for the time test, for the volume surge, for the pivot point conversion, you might enter the trade 2 points higher. Let us say you sacrifice 2% of the potential gain. You are paying a premium for security. But by entering later, you have successfully eliminated the 70% probability of being trapped in a false move. The cost of entering a few cents higher, secure in the knowledge that the move is real, is an investment in risk reduction. It is a few points of premium. The cost of entering early, getting stopped out, and suffering the subsequent loss and paralyzing psychological damage is a catastrophic expense. Certainty is the cheapest commodity on Wall Street, provided you are willing to wait for it. The only time the market gives anything away freely is when it is setting a trap. Pay the small premium. Secure the confirmation. Preserve your capital and, more importantly, your mental composure for the real opportunity. Never confuse cheap entry with smart entry. Incurred. The ultimate discipline, the discipline that underpins all lasting success in speculation, is trading what is, not what should be. Stop trading based on what your analysis suggests should happen because the fundamentals are sound, or because the pattern looks perfect, or because the news was positive. The market does not care for your opinion. The market cares only for the conviction of the capital being committed right now. You must only trade what the market decisively shows you is happening. The market must prove its case to you before you commit your capital. It must show the volume, it must show the time-held price, it must show the pivot conversion. If your analysis suggests a breakout is imminent at $60, but the price touches $60, dips immediately to $58, and the volume is negligible, The market has just demonstrated that your prediction is currently invalid. The impatient man will buy the dip, saying it must be ready to break next time. He is trading hope. The disciplined speculator waits. He says, "The market has shown confusion. I will wait for clarity." Confirmation is the bridge. It is the necessary span between educated speculation and actual investment strategy. Without that bridge, you are leaping across a chasm relying on luck alone. Prediction is speculation. Confirmation is strategy. If you are constantly losing money on false starts, on premature entries, it is because you have become enslaved to your own impatience and your eagerness to predict. Step back. Let the market do the work of clarifying its intentions. You are not paid to anticipate. You are paid to react decisively to undeniable proof. Patience is the ultimate discipline because it forces you to wait for the proof. It protects you from the emotional traps the operators are setting constantly. The man who cannot wait will eventually be forced to leave the game. The man who can wait will own the market. Confirmation is not an entry strategy. It is a defensive strategy. Your profits are made not merely by the trades you execute well, but by the multitude of catastrophic mistakes you don't make. The patience to wait for confirmation eliminates the vast majority of false starts, liquidity traps, and stop-loss hunts that ruin the average plunger. It preserves your capital for the moments of true opportunity. Wait for the volume. Wait for the time test. Wait for the conversion. Be certain, be surgical. The financial markets are unforgiving, and the act of preempting a move without proper confirmation almost guarantees that the trader will incur a costly market penalty for impatience. This brutal lesson and dozens like it were chronicled exactly a century ago, in 1923, when Edwin Lefebvre captured the indispensable strategies of the great operator, Jesse Livermore, referred to as Larry Livingston, in his seminal work, Reminiscences of a Stock Operator. Reading this account is not merely engaging with financial history. It is entering a necessary training ground, an apprenticeship that allows you to internalize the steep cost of Livermore's youthful errors without sacrificing your own capital. However, to fully translate this early 20th century market wisdom for the intricacies of modern trading, we highly recommend the annotated and commented edition prepared by Max Davidson. A link to this essential edition is provided in the description below.